Hey everybody, Don Snyder here, Priority Home Lending. Once again, thank you for being out there on the front lines and helping folks get into homes. You are doing a massive service to your society, to your economy, and to all of the folks that you are out there helping. We all appreciate it. So this is another one of my series of very short videos to answer a very specific question that I've been getting about the effects of the economic slowdown, COVID-19, all of that on lending and mortgage. So let me share my screen with you really quick, and I'm going to jump into the next question. And everybody has been asking about and wanting to know about what happens with employment and income when people are furloughed, when they're laid off, on temporary unemployment, all of these different things. And I have to say that the landscape is changing daily, but certain things are going to continue to hold true over time. And so let's just kind of talk about exactly what those are. Number one, you have to be working and making an income in order to close your mortgage loan. Guidance has come out from Freddie Mac, from Fannie Mae, from FHA, from VA, all clarifying their position on what stable and continuing income and employment look like. And we have guidance that we have to follow on each one of those to make sure that people really are still working at their jobs. Now, the nice part is that they've expanded the ways in which we can verify employment and income, and that's making our jobs easier and facilitating the fact that HR departments are not sitting there fully staffed and ready to verify your employment. And so, of course, they've got other things going on until we now have options to verify income and employment, potentially with less hassle, less delay, less headache. So that's a really positive thing. I am looking forward to taking advantage of it. Let's see here. So this is the crux of the matter. Borrowers are thinking that they don't have to repay their mortgage loan, which is just simply very problematic and not accurate. So one of the big things that we're trying to prevent right now is from borrowers getting into homes and then immediately going into forbearance, potentially for up to 6 months. This is not a grace period on a credit card that we're talking about. At the end of the day, that loan payment still has to be made. So if the consumer, right, or your home buyer is not making their loan payment, we still have a servicer in the middle who has to then pay the investor, they pay the county for property taxes, they pay out insurance companies for homeowners insurance, right? These are legally required by their contract. And when we have gone from 0.25% of mortgages requesting forbearance to well over 3.5%, that creates major issues. So at the end of the day, it's in everybody's best interest to make sure that the moment somebody buys a house, they have the ability to repay that loan. So beyond the massive economic impacts of this, we want to make sure that we're not putting people in a position to where they can't fulfill their obligation, and it has a lasting effect on their ability to obtain credit. And so, these are battles that we're fighting every day, but they're really extremely important. And you know what, let me go back to this. And so one thing that we're seeing in response to this as well is a tightening in lending standards. It is going to become more difficult, or it's already becoming, and it will continue to become more difficult to qualify for a mortgage. In a lot of cases, what we've seen is that people who are already qualified and in the process, right, or they're approved, then you know what, let's move forward in many of those cases. But starting out now, we're going to see higher credit scores be required, and it's going to be more difficult to finance difficult properties or difficult income situations. There will be fewer exceptions granted. And so this is a temporary situation, but it's important to understand. So let's go back to our first screen. And I'm just going to hit on this again. You have to be currently employed. Unemployment, 99% of the time, does not count for income, right? you have to have a history of your income. And ideally, you don't have a long history of unemployment income. So these are really important. And then another thing to understand is that, as lending standards are tightening, additional overlays or additional rules will be included on loans. And so one that we're seeing is that now we have a borrower attestation that has to be signed at closing in order for our investors to take these loans from us. And it basically says, I'm not facing hardship due to COVID-19. I've not faced a reduction in my hours or my pay. I have no plans to go on forbearance for this loan. And so they are attesting legally that all of those things are true. So at the end of the day, I know that this is really a pain, but by following this guidance and making sure that people have the ability to repay that loan, we're in the long run really helping them out with avoiding forbearance and foreclosure, which can have long-lasting effects on their financial situation. So hopefully this has been insightful for you. If you have any questions of things that I didn't address or could have maybe explained a little bit differently, please shoot me an email or a text message, whatever it takes to get a hold of me, and we will discuss it, because I just love talking about guidelines. That's the kind of nerd that I am. So you all have a great day, and I'll see you again with another video soon.